In America, most people never hear the phrase retained earnings outside of an accounting class, yet they live inside its consequences every day. Picture a busy downtown street in Chicago at 7:45 a.m. Office lights flicker on, delivery trucks unload inventory. Baristas prepare for the morning rush. Behind every one of these businesses is a quiet decision that rarely makes headlines. When a company earns a profit, it can either distribute that money outward or keep it inside. What it keeps becomes retained earnings. At first glance, it sounds technical, but psychologically, it mirrors something deeply human. When an American household earns extra income, a bonus, a tax refund, overtime pay, there is an emotional crossroads. Spend it now and feel immediate relief or reward, or hold on to it for something bigger later. That tension between present satisfaction and future stability shapes almost every financial choice we make. Corporations experience the same tension, just on a larger scale. In the decades I've spent studying financial behavior, I've seen that retained earnings are less about accounting and more about identity. A company that retains profits is signaling how it sees its future. Is it cautious, ambitious, defensive, opportunistic? These decisions ripple outward to workers, customers, and entire communities. Think about a mid-sized manufacturing company in Ohio. It finishes the year with strong profits. Instead of distributing everything to shareholders, leadership keeps a portion inside the business. That retained capital may fund new machinery, upgrade technology, or build cash reserves for an economic slowdown. On paper, it's a line item. In reality, it becomes new jobs, overtime hours, and stability during uncertain quarters. For everyday Americans, retained earnings shape job security in ways most never notice. When companies build internal cushions, employees often feel steadier during recessions. When companies distribute aggressively and keep little inside, the margin for error shrinks. Layoffs can follow quickly when revenue dips. There is also a psychological layer in public markets. Investors often interpret retained earnings as a statement about long-term belief. If profits stay inside the company, leadership is saying, in effect, we think we can grow this further. That message influences confidence. Confidence influences stock prices. Stock prices influence retirement accounts across the country. In 401k plans and pension funds, millions of Americans indirectly participate in this decision cycle. They may never analyze a balance sheet, yet their financial futures are shaped by whether companies reinvest or release their profits. Retained earnings quietly compound inside businesses, the way savings compound inside households. But there is tension here, too. Retaining profits can be seen as discipline or as withholding. Employees may wonder why wages aren't rising faster. Shareholders may question why dividends are lower. Communities may ask why local investment feels slow. The same dollar can create multiple emotional reactions depending on where you stand. At its core, retained earnings represent a belief in tomorrow. It is a choice to delay immediate distribution in favor of potential expansion, resilience, or strategic flexibility. And that choice reflects a broader American financial story. The constant negotiation between now and later, between consumption and growth, between security and ambition. There is a moment that happens at the end of every profitable year inside a company. The revenue has been counted. Expenses have been paid. What remains is profit, but profit alone does not determine the future. The decision about what to do with it does. In Los Angeles, a retail chain closes its books after a strong holiday season. Executives gather around projections on glowing screens. They debate expansion into new neighborhoods, upgrading supply systems, or strengthening cash reserves. Every option competes for the same pool of retained earnings. What looks like a purely financial discussion is, in reality, a debate about risk tolerance and human confidence. Retained earnings act as a memory bank of past success. They accumulate over time, representing years of disciplined operations and favorable market conditions. The larger that balance grows, the more strategic flexibility a company gains. But flexibility also introduces temptation. The more internal capital available, the easier it becomes to justify ambitious projects. This is where psychology becomes critical. Human beings are prone to overconfidence after success. When profits accumulate year after year, leadership may interpret that pattern as skill rather than circumstance. Retained earnings can then fuel aggressive expansion, acquisitions, or experimental ventures. Sometimes that confidence is justified. Other times it reflects what behavioral scientists call recency bias, assuming the recent past will continue indefinitely. On the other side, retained earnings can also signal restraint. Consider a family-owned manufacturing business in Wisconsin that has quietly built reserves for decades. Its leadership remembers prior recessions, supply shocks, and market disruptions. For them, retained earnings represent protection. They are less interested in dramatic growth and more focused on endurance. That conservative approach shapes hiring decisions, WAHE policies, and investment timing. For employees, these strategic differences are rarely explained in emotional terms. Workers may simply notice that one company feels bold and fast-moving, while another feels steady and cautious. Underneath those cultures lies retained capital, the accumulated profits that enable or restrict action. For everyday Americans watching economic headlines, retained earnings often influence market narratives. Analysts interpret rising corporate reserves as a sign of strength or hesitation depending on the broader climate. In boom periods, large retained earnings can be seen as dry powder waiting to be deployed. In uncertain periods, they can signal defensive positioning. There is also a subtle feedback loop between consumer behavior and retained earnings. When consumers feel secure, they spend more freely. Corporate profits rise, retained earnings grow. Companies reinvest, hire, and expand. That expansion reinforces consumer confidence. The cycle feeds itself. But when fear enters a system, rising unemployment, geopolitical tension, financial instability, consumers pull back. Profits slow. Companies preserve retained earnings rather than deploy them. The emotional tone of the economy shifts. At its core, retained earnings sit at the intersection of math and memory. They are calculated precisely, yet shaped by stories leaders tell themselves about the future. Every retained dollar carries a narrative about what tomorrow might hold. In the long arc of American business history, retained earnings have quietly shaped some of the country's most recognizable institutions. Long before companies became household names, many relied not on constant outside funding, but on profits kept within the business. Those retained earnings became the internal engine that powered expansion across states, industries, and generations. Consider a regional grocery chain in the Midwest that started with a single storefront decades ago. Each year, after paying expenses and taxes, a portion of profit remained inside the company. That accumulation funded the second location, then the third. Over time, retained earnings financed warehouses, logistics systems, and employee training programs. Growth was not fueled by dramatic headlines. It was fueled by patience. This pattern reflects a deeply American tension between independence and external reliance. Businesses that build substantial retained earnings often gain autonomy. They are less dependent on new investors or emergency borrowing. Autonomy changes decisions. Leaders can prioritize long-term stability over short-term optics. They can weather criticism with less vulnerability. Financial independence, whether in households or corporations, shifts psychological posture from reactive to deliberate. At the same time, retained earnings reveal how uneven financial power can become. Large corporations with decades of accumulated profits operate on a different scale than new startups with limited reserves. The gap influences competition. Established firms may use retained earnings to invest in research, marketing, or strategic acquisitions, strengthening their position. Smaller businesses, with thinner margins, often operate closer to the edge. The system amplifies prior success. For workers, this dynamic affects career paths. Employment at a firm with strong retained earnings may feel more secure, especially during economic downturns. Benefits, training budgets, and long-term projects are easier to sustain when internal capital is available. In contrast, companies with limited reserves may freeze hiring or cut programs quickly when revenue slows. Employees sense these differences, even if they never review a financial statement. There is also an emotional narrative embedded in retained earnings. In American culture, the idea of reinvesting profits aligns with values of building and self. It mirrors the small business owner who reinvests early earnings to expand operations rather than taking all profits home. The discipline required to retain earnings reflects delayed gratification, a trait consistently linked to long-term growth in both individuals and institutions. Yet balance remains essential. Retaining too little can weaken resilience. Retaining too much without clear purpose can signal stagnation. The healthiest patterns often emerge when retained earnings, aligned with a coherent vision, growth when opportunity is strong, preservation when uncertainty rises. Over decades, these accumulated decisions compound. Retained earnings from one year become the foundation for the next. They shape hiring trends, innovation cycles, wage trajectories, and community development. They influence how confidently businesses respond to change. They help determine which companies endure and which fade. In the end, retained earnings are not simply the profits left behind. They are the financial memory of past discipline and the quiet vote of confidence in what lies ahead. Across cities, industries, and generations, that quiet vote continues to shape the everyday economic reality of millions of Americans. Step into a suburban neighborhood outside Atlanta at dusk. Porch lights flick on. Inside one home, a couple reviews their household budget at the kitchen table. They decide to leave part of their bonus untouched in a savings account. They do not call it retained earnings, but the instinct is the same. Keep something inside the system to protect the future. Corporations operate with a similar instinct, only magnified. Retained earnings accumulate year after year on a balance sheet, reflecting profits not distributed. Over time, that accumulation becomes a financial backbone. It influences credit ratings, borrowing power, and negotiating strength. A company with substantial retained earnings often appears more stable to lenders and partners. Stability shapes opportunity. In American financial culture, strength is often associated with visible expansion. New offices, product launches, public announcements. Yet retained earnings are quiet strength. They do not always create headlines. Instead, they create options. A firm with internal reserves can choose when to act rather than react. That freedom alters behavior. When the COVID-19 pandemic disrupted business activity across the United States, companies with larger retained earnings had more room to absorb shock. They could continue payroll longer, renegotiate contracts from a position of stability, or adapt operations without immediate crises. For employees, this translated into fewer abrupt changes. For communities, it meant fewer sudden closures. But retained earnings can also influence corporate culture in less visible ways. When leadership knows the company has financial cushioning, decision-making can become more deliberate. There is less panic in downturns and less urgency to chase every trend. Conversely, when retained earnings are thin, stress rises, urgency increases. Risk-taking may either spike or freeze entirely, depending on leadership temperament. From a behavioral standpoint, retained earnings affect confidence loops. Strong internal reserves create psychological safety. Psychological safety encourages planning. Planning supports long-term projects. Long-term projects, if successful, increase profits, which then expand retained earnings further. The system reinforces itself. Yet there is another side. Excessively large retained earnings can raise questions among stakeholders. Why is so much capital sitting unused? Is leadership too cautious? Is innovation slowing? In the American market system, capital is expected to move. Idle resources can create tension between patience and performance. For retirement savers in index funds, these corporate dynamics remain largely invisible. Still, the consequences appear in quarterly earnings reports, market valuations, and long-term growth patterns. A company's choice to retain profits rather than distribute them shapes reinvestment pace and competitive positioning. Over decades, those choices compound. Retained earnings, then, become more than a financial metric. They represent accumulated discipline, fear, ambition, memory, and belief. They reflect how organizations interpret uncertainty and opportunity. In a nation built on risk-taking and expansion, the decision to hold something back carries both caution and confidence at once. In the end, retained earnings quietly tell a story about how much faith a company places in its own future and how much patience it believes the future deserves. Have you ever wondered what companies do with all the money they make? After they pay all their bills, salaries, and taxes, where does the leftover cash go? Well, a big chunk of it is called retained earnings, and it's a super important concept that affects not just the company, but you, me, in the entire economy. So, what are retained earnings? Think of it like a company's savings account. It's the cumulative profit that a company has earned over its lifetime, minus any dividends it has paid out to its shareholders. Instead of giving all the profits back to investors, the company holds on to this money to reinvest back into itself. Now, why would they do that? Imagine a company wants to grow. They might need to build a new factory, develop a groundbreaking new product, or expand into another country. These things cost a lot of money. Instead of taking out a huge loan and paying interest, they can use their retained earnings. This is a powerful way for a company to fuel its own growth without relying on outside financing. It's like using your own savings to renovate your house instead of getting a bank loan. This reinvestment is where the magic happens for the economy. When a company builds that new factory, it needs to hire construction workers, engineers, and project managers. Once the factory is up and running, it needs factory workers, supervisors, and administrative staff. See the ripple effect? One company's decision to reinvest its retained earnings creates a wave of new jobs, and it doesn't stop there. For employees already at the company, this growth can mean more opportunities for promotion, better job security, and even higher wages as the company becomes more profitable and competitive. A growing company is a healthy company, and that's good news for everyone who works there. When lots of companies are reinvesting their retained earnings, it's a sign of a strong and confident economy. It shows that businesses believe in the future and are willing to bet on their own success. This investment drives innovation, boosts productivity, and ultimately leads to economic growth that benefits society as a whole. So, the next time you hear about a company's profits, remember, it's not just about a number on a spreadsheet. A significant part of that profit, the retained earnings, is the fuel that powers business growth, creates jobs, and helps build a stronger economy for all of us. It's the corporate world's way of investing in a better future. Thanks so much for watching. If you found this helpful, give this video a like. And do you want to forget to subscribe for more insights into how the world of business and finance really works? See you in the next one.